Hey guys, it's Alex here, and I want to show you guys a sample property that we've bought with a joint venture. Now, there's a lot of different ways that joint ventures, as I said, can be structured. There's a lot of different uh, strategies that can be executed with joint ventures. In this particular case, it was a BRRRR strategy. So, BRRRR is an acronym that stands for buy a property, renovate the property, rent out the property, refinance that property, and then repeat the process. So BRRRR, that's the acronym. So in this particular property, our purchase price, we found a dilapidated property. Actually, happened to be in St. Catharines, but we invest kind of all over Ontario and in the US. So our purchase price was $350,000 on this. You might say, oh, well, those are rare properties. We find properties that are under market all the time. That is my role as a finder, which is part of the joint venture quadrant, if we consider it. My role is to find properties that have value add opportunities to them. Okay, so in this particular case, it's in a beautiful neighborhood, substantially undervalued, off market, so it wasn't available. The reason it got offered for so cheap is because it has some foundation issues, and that typically would scare away some investors. However, we knew how to deal with it. It was quite straightforward. Did require some capital investment, but not beyond our scope of competence. So we bought this place for $350,000. Our construction costs on this particular project was $180,000. Now, during this, that $180,000 also has a carrying cost component. So when you're buying a house, you still have to pay insurance on it. There's still financing costs. For example, a partner who would be bringing the capital to help us execute this, they would be incurring interest on that line of credit. Remember, partner gets paid back every penny that they put into the deal. That's how these joint ventures work. By the time that the partner gets their money out, we're now $0 in on this deal. We still remain partners, 50-50 partners on an asset that we have no money invested in it collectively between us and the money partner. And so, for very simple math, you can't divide by zero. So your return on investment actually becomes infinite. But anyway, in this particular example, I'm showing you guys one where the partner does have a little bit of capital in it, but I'll show you just how powerful that looks. So anyway, our financing costs on this were $10,000 roughly. It was plus or minus just a very, very little bit. So I'm just using this for round numbers to make it very simple. So our total in on this property was $540,000. Okay, perfect. So now we have this asset. We've gone to the bank and we've said, okay, bank, we originally bought this place for 350. So the partner had to come up with 20% down payment so we could secure the asset. They had to come up with $180,000 through lines of credit or maybe the RSPs or maybe some other way of attaining that capital. Now we're at a point where we have this asset that has been converted. It's now beautifully renovated. All the ailments or anything that was wrong with it is being fixed. It's now top notch. We've gotten the place rented. We're getting beautiful rents on the place. Now we want to go to the bank and say, okay, bank, we have this brand new duplex in this particular situation. It is completely renovated. We'd like you to come appraise the property. So this is in the BRRRR, the buy. We've renovated it. We've rented it out. Now we want to refinance to pull the capital back out. So we go to the bank, and in this particular situation, the appraisal on this property came in at $650,000, right? Just where we thought it would be. So at $650,000, remember the bank wants us to keep skin in the game, our skin. But we want to leverage the bank's money, which is the 80% that they're going to loan us on this. So in this particular situation, the bank is actually going to loan us $520,000. Now, if we look here from the $520,000, we put in $540,000, but now effectively, we've managed to buy a brand new cash flow producing duplex, and we only have $20,000 in this deal. That's pretty sweet. So you might say, well, yeah, but I didn't get all my money back out. most investments, you have to keep some capital in the deal. And we have done a tremendous amount of BRRRRs where they call it the perfect BRRRR, where you pull all the capital back out. We've pulled massive surpluses out of BRRRRs where, upwards of 50, sometimes even over $100,000 on BRRRRs. So it can be done. I've done it personally. Our partners have made a lot of money with BRRRRs, especially in these strong real estate markets. However, being realistic, we know that there are going to be times where we have to have capital still in the deal. That's okay. The goal is still to get that money and pull that back out so that we're now at a point where we have $0 in the deal and we can go and repeat the process, which is the last R. Okay, so now we have this asset. We still have $20,000 in the deal. I want to break down what that deal actually looked like on the back end, because despite the fact that we have that, let me just clear the screen here. So we have still owed. 1 second here. So still owed is equal to 20K to the partner. Okay, so that $20,000 is going to be earmarked at any subsequent refinance. So let's say the property has been paying itself off, the property has appreciated in value. We can now say, okay, you know what? Let's go back into this property. Let's reappraise it again. See if we can pull out that $20,000. That happens all the time. We've done it. So the property's performance, however, is something that's very, very interesting and something that should be noted. So this property is it's modest cash flow. So we're going to call it cash flow per month is $250. Now per year, it's $3,000 per year. Okay. Our mortgage pay down on this for the year is $8,500 per year. Okay. Lastly, appreciation. If we take a historical average of about 4% on this property, our 4% appreciation is $26,000 per year. So, well, for the first year anyway, it does compound, right? So if we take a look at this, in 1 year's time, our cash flow is $3,000. Our mortgage has paid itself down, the principal has $8,500, and the property has appreciated $26,000. So that in 1 year is a total of $37,500. So you say, I'm still owed $20,000, but in 1 year's time, this asset has actually produced substantially more, almost twice what we have invested in this property. And that's just in 1 year. Now, markets fluctuate, interest rates go up. We typically have buffers to control all of these things, or at least mitigate risks that take place. However, I think personally having a $37,000 gain in 1 year is pretty dynamite when it comes to doing a joint venture. So give us a call, reach out to us, and we'll talk to you about other opportunities that we've had and other successes, because I'd love to share with you.